If I had $1 million, if I had no chance. If I had $1 million right now, here's what I do with it. I'm going to give you my plan of what I would do. Now, maybe I'll win the lottery, maybe I won't. But if I get a cash influx of $1 million right now, this is my plan. Maybe you can take this plan and apply it to your future savings, not counting on the fact that you're going to get $1 million, but in the fact that this is just my ideas about investing, specifically investing in real estate. You'll see it's very heavily invested into real estate, or my plan is to invest heavily into real estate, because it's what I know. I know real estate, and I know it's always been a very safe investment. Cue all the negative comments down below about investing and real estate and how the bubble's going to burst, but don't listen to them. Real estate is a solid investment and will continue to be a solid investment, specifically in Canada, over the next little while. And I'm going to show you my investment strategy moving forward. But right after I ask you to hit that like button. Remember, hitting that like button helps get this information out to other people much like yourself who are interested in learning more about investing and in real estate. So please hit that like button. My job here is to educate you. And this is not your plan. This is my plan. But my job here is to educate you, and your job is to hit that like button and get this info out to other like-minded people. Okay, so let's get into it. I have $1 million magically from somewhere, came out of the sky, landed in my pocket, and here's what I would do. But a lot of people would say, if I get $1 million, what I'm going to do first is pay off my mortgage. And I'm actually going to suggest that that is not what I would do. And the reason for that is inflation and the theory that it's going to be easier to pay down my mortgage at this rate now in the future. So in other words, if I have a $1,000 payment when I get, or $1,500, let's say, when I get my mortgage, it's going to be easier to make a $1,500 payment in the future than it is now, because I'm likely going to make more money as time goes on. So I'm not going to pay down my mortgage whatsoever. Well, that's not okay. That's not 100% true. I have a part HELOC and a part fixed term mortgage. So I'm not going to pay down the fixed term mortgage, but my HELOC, because I want the ability to access capital if I needed, my HELOC's currently sitting around 24.5 on my house. So I'm going to pay down that HELOC portion for the option to possibly free up and get access to that capital if I see an investment in the future that I want to act on. So there's 24.5 out of the way. The next thing most people should do, you should do it if you haven't, but I'm not going to, because I'm actually currently maxed, is max out my RRSPs in order to get that tax benefit back. So my dollar on this is going to be zero. Yours hopefully will be a lot more, and you pay down, or you max out your RRSPs. And there's a specific reason I will no longer be paying into RRSPs, and that is because I want to invest heavily in property. And the days I do invest heavily in, the years I do invest heavily in property and I actually go to sell them, I want big RRSP contribution room to offset the capital gains. So I would suggest myself, I'm not going to have RRSPs. If you don't, please max out your RSPs as soon as you possibly can, if you can. But one thing I have not done over the years, and I'm sure my financial planner is going to kick my butt for it, I have not used my TFSAs, tax-free savings account in Canada. You can, I think it's 75.5 this year, you can max out. So I would take 75.5 of this $1 million, put it directly into my TFSA and max that out, because I've never actually had that contribution. So there's 100 grand gone already. And TFSA, don't think of that as a savings account. It's called a tax-free savings account, but you can invest that in stocks and bonds and whatever else you want to invest it in. So just take it, and just know that if you do invest in that TFSA, any earnings you make off of that money is all tax-free. So that's why I want you to max that out if you have the opportunity after your RRSPs. Okay, so my HELOC is paid off and I have that capital access if needed. My mortgage is still in place because it's not that expensive. My TFSAs are absolutely maxed. I'm going to take another $100,000 of this and I'm going to invest it. Now, personally, I like to invest in private mortgages. And then I also have a bunch of money with a financial planner. I do not play the stock market because I don't understand the stock market. I understand real estate, and that's usually why I invest so heavily into real estate. And that's where I think my money should go, because I understand it. But I will take a portion of this, 10% of this fictional money that's coming in, I'm give it to my financial planner and or put it into a MIC or mortgage investment corp, and hopefully get somewhere between a 6 and 10% return each year. I think it's kind of funny because I don't think those returns are, I've never actually actualized a lot of them as high as 10%, except for this recent run that we've been on. But I mean, even 3% all the way up to 6.5% is a pretty steady return. Okay, but now you're following this channel likely, and subscribe if you haven't already. You're following this channel because you're into real estate, and specifically Canadian real estate, my marketplace of Surrey, BC. So I'm going to use my Surrey, BC numbers and tell you how I would buy 3 separate properties. Now, my theory on buying properties is very, very specific. I don't like pains in the butt. I don't like headaches. And most people want to invest in single family detached homes because they show the most possibility for future growth. And I understand that. However, I think the strata fee that you pay is likely worth the not having the inconvenience of actually maintaining the home yourself. So my personal way I like to invest is actually in stratified units, where if the roof leaks, it's not my problem. The strata management and the strata council have to take care of that. Okay, so I'm going to buy 3 separate properties. And there's also another reason that there's 3 separate properties. If you own one detached home, when you could buy, say, 3 condos, if you have to sell that asset, you're now selling that whole asset altogether, as opposed to a condo. If you did need to sell one off at a time or the whole thing, you could sell 3, you could sell 1, get access to the capital that you wanted to make, or any profits, take advantage of that as well. So I'm going to buy 3, and these are the 3 types of properties I would buy, and I would buy them all in my marketplace of Surrey. My whole life is here. I don't know other markets. I know Surrey and the Fraser Valley best. So I'm going to first start off by buying a 1-bedroom condo. Now, a 1-bedroom condo is probably going to cost about $400,000 in my marketplace. That's 140 grand down. Now, I could put less than that, right? You can put only 20% down if you want, but I want these numbers to break even. My strategy is always to have those numbers break even and not have tax. So $400,000 purchase, I'm going to put 35% down, and that's the number I've chosen for every single property I want to buy, 35%. So there goes another $140,000 out the door. $400,000 1-bedroom apartment should rent ideally for $1,400, maybe a little bit more, and my carrying costs are probably going to be, well, given the interest rates at 2.25, I'm going to budget high. My carrying costs will almost be $1,500 a month. So that particular property, I'm going to be paying into slightly as we go on. So here goes property number 2. I'm going to now invest in also a 2-bedroom in my marketplace of Surrey, BC. You're probably going to get into a 2-bedroom, a really nice 2-bedroom that you'd be proud to own for about $550,000. That down payment portion coming off that $1 million, that fictional $1 million, is now 192.5. So that's my 35% down. Remember, I want to stick with that number of 35% down because that's where I like to see the break even numbers for the most part. The rent I expect out of that is $1,900 a month. Now, I recently just did something very similar to this. I just bought a 2-bedroom place. Now, prices were lower, about $75,000 less when I bought. So my break even numbers was better off actually at 20% down. But 35% down, $1,900 expected rent. The place I rented out is now $2,100. So I'm erring on the side of caution here and budgeting. What if I only got $1,900 for it? And then my actual money out every month is $1,866. Now, $1,866 means I'm profiting, but just ever so slightly. Again, I want to break even on these rentals. And the last property, I'm going to get out of condos, but I'm going to stay in strata because I don't want the headache. And I'm going to get into a 3-bedroom townhouse. So now I'm kind of, I mean, it's not really diversifying because it's all in real estate, but I'm kind of diversifying because I've got a 1-bed, 2-bed, and now a 3-bed unit. So a 3-bed townhouse in the city of Surrey, a really nice one. Again, you want to be proud of I don't believe in being a slumlord whatsoever. You want to be proud of the units you own. I would probably spend somewhere in the neck of the woods of $750,000. My 35% down is now going to be $262,500. And that should get me at least $2,300, probably $2,350, maybe even a little bit more. And again, you're going to notice this when the expenses going out are actually now $2,360. 63 each month. But when I've calculated these expenses going out and coming in, that includes property tax, insurance, HOA or strata fee or HOA fee, as they call it in the States. It includes all of my expenses for the entire year. So if I look at those numbers with 35% down on 3 separate properties, I'm probably going to get somewhere in the neck of the woods of $56.50 a month incoming rent. I budgeted low, so that number may go up. And then my outgoing dollars every single month as a total, remember that includes property taxes and everything, is $57.22. So if I actually do get a little bit higher rent, these will break even completely and I will have almost no income tax. Now, that's not necessarily true because you do still pay income tax on the principal portion that's getting paid down in your mortgage, but I don't want to cash flow positive on these because I don't really need to. I don't need to live off of the income. What I want them to do is pay down the equity. And as the property grows in value, I'm going to get that equity, but I'm also going to have somebody else paying off my leverage debt. Now, buying properties in BC is not free. We have a very heavy transfer tax in BC. So on those 3 properties, I'm going to set aside $28,000 in order to pay what I call the oil tax. Alberta has oil. I always say BC has a real estate transfer tax. So I'm going to pay almost $30,000, $28,000 in transfer taxes to acquire these 3 properties. And I've probably got another $3,000. Well, you know what? I'm probably going to have to ratchet up that number a little bit, but I put down $3,000 for closing costs. So a lawyer in order to actually transfer the titles into my name. And next, maybe I need to take some of those closing cost lawyer fees out of this next budget, but I did set aside also another $10,000 for any renovations of those units. There's always going to be surprises. Even if you buy the perfect place, which I thought I bought, all we did was clean it up and paint it and put $350 in. Day we moved in, washer and dryer kicked the bucket, there's another $2,200. So I set aside $10,000 for renovations and alterations of these units in order to get them to a spot where I can rent them for top dollar. And that leaves me with, what am I at here? About $164,000 remaining. Well, I want to keep probably $100,000 worth of cash. And when I mean cash, I don't necessarily mean cash in the bank, because remember, I have that HELOC on my house with access to capital if I need it in a very short amount of time. So with cash, I mean, I'm probably going to invest this, but I'm going to invest this in very liquid assets that I can pull out if I need it. So this money actually may be going back to my financial advisor, but I'm not going to put it in a TFSA, and I'm not going to put it in a spot where it's locked into an RSP. So with that 100 grand gone, I've got $64,000. And well, let's face it, you're probably going to want to spend a little bit of this fictional money, right? So I'm going to say that that's $64,000. I'm happy with my vehicle, but my wife, she's been eyeing up a couple of new cars. So I'm probably going to try and take that 64 grand and not put any more money into her future car upgrade. And just like that, between my TFSAs, my RSPs, paying off my HELOC, not my mortgage, remember that, investing in the stock market, buying 3 properties, paying for the taxes, renovating those properties, all the closing costs, and having some cash on hand and a brand new vehicle, I have spent $1 million. And this video is only a couple of minutes long. So $1 million doesn't necessarily get you very far, but what they will do is they will get you to the spot where you can own and invest. And hopefully all these properties continue to rise in value and they pay for themselves, and you can just continue on your merry way. Now, again, $1 million is not what it used to be. You can't retire on $1 million, but if you follow this plan, you're going to have a whole lot of assets to retire when the time comes. So unfortunately for you, you still have to keep your job. So sorry for the bad news. You're still working even with your $1 million. I'm still working even with my fictional $1 million. Thanks for watching and having a little bit of fun with me today. It's only what I would do. I wish I could do it. If you want to give me $1 million, please let me know down in the comments. Otherwise, click subscribe. It really helps the channel. And if you haven't already, make sure to hit that like button. I think everyone that hits the like button in this video actually wins $1 million.